Hello, I'm Steven, the calculator guy, and today we're going to talk about the different types of USD pegged assets and their varying levels of risk and safety. I know, guys, this is a bit late. And I know that many of you will be incredibly mad or upset that I'm even making this video given the current climate. But the hope here is that it will allow anyone who is still in the space to avoid the mistakes of the predecessors who are, us. Anyways, let's jump right into it. The first thing I want to show you guys is a tweet from Sassel and a response by Vitalik. Sassel, who is a really big name in the Ethereum ecosystem, said to stop experimenting with Ponzi's, algo stables, and yield farming. I take umbrage with yield farming or other unstable nonsense. That's fair enough. Start experimenting with public goods, funding, governance, DAOs, decentralized identity reputation, regenerative finance, and privacy tools. Okay, there's an extent to which I agree with this, especially with the privacy tools, regenerative finance, and governance. However, governance assets are also very unstable, and we're in a bearish market, so I don't know how great of a investment that would be, but it would be interesting and helpful to understand governance and participate in it, certainly. Now, one thing that I like about Vitalik's response was that algo stable is a propaganda term serving to legitimize uncollateralized stables by putting them in the same realm or arena as collateralized or over-collateralized stables like DAI or RAI. So, effectively what he's saying is we shouldn't necessarily be calling these algo stables because it makes them feel like just another class of stables, right? And so we put a lot of false faith into them. Now, hindsight's 2020. It's easy for anyone, even Vitalik, to say this now. But who was shouting from the rooftops about this prior to the exploits on USDN and on UST? Well, if you want someone to follow, Oxhams was not only talking about the potential vulnerabilities for a death spiral for UST, but also called the USDN vulnerability prior to that issue as well. So you can love to hate him or hate to love him. I just love the guy. I think he does great work, and you can tell from his posts that he puts a lot of time and effort and research into them. Is he 100% accurate all the time? Perhaps not, but the level of research that goes into his post is top tier, and he did predict both USDN and UST. So, someone to follow. Anyways, let's jump into stablecoins. There are a bunch of different types of stablecoins, but the main three are collateralized stablecoins like USDT and USDC, over-collateralized stablecoins like DAI and MIM, and then algo stables and then partial. So I guess there are four. Partially backed, partially algo like Frax, and then finally full algo like UST and I believe USDN. So let's jump into those and look at some analytics. The first two we're going to look at are collateralized, the most popular. This is USDC and USDT. So with USDC, right, this is the most popular stablecoin that exists. There is a ton of it in circulation. It is the primary stablecoin utilized by exchanges like Coinbase. And BlackRock is the primary manager of $50 billion USDC reserves. If you don't know who BlackRock is, I recommend giving it a Google. It will be well worth your time to understand who owns everything, right? So BlackRock has a vested investment in USDC. It is the largest stablecoin, and it is claimed to be fully backed. And so you can say, okay, well, I would much rather see it. Like, for example, with DAI, we can see the on-chain data to show what DAI is backed by. With USDC, there is no on-chain data. Here we see USDC is backed by cash and short-dated U.S. government obligations, so that it is always redeemable for $1 to $1. Each month, we publish the attestation reports by Grant Thornton regarding the reserve balances backing USDC. Now, pros and cons of this, right? Each month, they do publish a report attesting to the legitimacy of their backing. However, when you have a $50 billion backing, or when you have BlackRock involved in your financials, I think it would be prudent to say anything could be said, or you could have anything said on your behalf. But, that's just me in my tinfoil hat. Let me take that off for a second and look at the actual attestation reports, right? You can read through this if you want. Effectively, they're saying how many coins are in circulation, right? They 51.4 billion. And then later on, down here, you can see the circulation versus the fair value US dollar denominated assets held on behalf. Now, the fact that it's exactly the same down to the dollar is a little bit suspicious, because if you have any assets, the odds of them holding their exact dollar value is very unlikely. But here he says, total fair value US dollar denominated assets held on behalf of USDC holders is at least equal to 51 billion. So I guess what they're implying here is that it is at least equal to everything they have, but maybe even more. And then, you can read the criteria and this and that. So effectively what we have here is USDC attested to be fully backed, at least fully backed, perhaps over collateralized by paper assets, money assets, USD, as well as government issuances and things of that nature. So that Circle, that is the most popular stablecoin. Let's go to the second most popular stablecoin and see what's going on there. So that would be USDT. Now USDT, let's just pop this up really quickly in TradingView. USDT had a depegging event right after UST, and a lot of people were really scared and sort of fleeing USDT. You could see the curve pools becoming unbalanced, but personally, and if you were in the Discord, you saw this, I did give my vote of faith to USDT because you can redeem, big players can redeem their USDT for USD, right? You have to do it in $100,000 chunks, but it is possible through Tether.to. Anyways, USDT, and some people hate USDT, absolutely despise it, right? There are people who are fully anti-USDT, and who am I to poo-poo their, let me take off we don't need this right now. Let's go down to hourly. You can see here was the depegging event. It went as low as, I think, 94 cents, right? Which is a huge depegging for the second largest stablecoin that exists, right? So you can see it's very well pegged. Boom, big depegging event. And now it's regaining stability right now. It has gone down to 99.6, which is, a little bit lower than usual, but then it's trending back to 99.8 is the usual bottom, and then where is it? $1 exactly is usually the top. So that's where it usually stands. We can see in the past there have been a few small blips up and down, but by and large, very stable. Okay, now that we've looked at that, let's look at the transparency. So it says all Tether tokens are pegged 1-to-1 with matching fiat currency and are backed 100% by Tether's reserves. So cool. All right. You can look at the current balances where the Tether exists, but more than likely you're wondering, well, how is it backed? MHA, Cayman, and more, they are the ones who generally do the reserves report, who effectively saying this is the assets, or we have looked at the assets that are held. You can see the breakdown, right? Cash and cash equivalences or other short-term deposits in commercial paper, right? That's 83%. That's the vast majority. Corporate bonds, secured loans, and other investments. So that would be the backing here to make 100% of their total backing. And then you can see cash and cash equivalences, which is this, how it's broken down. Treasury bills, reserve repo notes. You probably can't see because my big face is in the way. Cash and bank deposits, commercial paper and certificates, and then money market funds. Money markets, if you don't know, are borrowing and lending platforms. Okay, so there we go. That is USDT in a nutshell. They are collateralized, not over collateralized, but collateralized. They have at least 100% collateralized according to them and according to MHA, Cayman, and more. Now you can dig into those two deeper to see how well you have faith in them. Again, this is off chain. So after you work in blockchain long enough, you start to realize the need for blockchain. And we're going to see this really right next, because the next asset we're going to look at is an on-chain asset. So with these, we're putting faith in these sort of auditing institutions to be honest and to have done a good job in looking at the reports of Tether and the reports of Circle. With DAI, we don't need to do that because it's on-chain. So DAI is it's MakerDAO, right? So MakerDAO has DAI. DAI is like the top decentralized stablecoin, and people don't like DAI for one reason really, and that it has a lot of USDC backing. Okay, so this is DAI. This is all on-chain analytics. You can also look at the Dune analytics, but I prefer this because it shows the data that I am particularly looking for, which is how is DAI backed. Well, DAI, again, by MakerDAO, is over-collateralized. So what are over-collateralized assets? Over-collateralized assets are assets that you mint against collateral. So first you must provide collateral, and then you can mint these stablecoins against that collateral at an LTV. LTV just means loan to value. So let's say you put in $100 of Ethereum. You don't want to get liquidated, so you only borrow $50 of DAI. Now, if Ethereum's value starts to go down towards the liquidation level, your Ethereum will get liquidated to ensure the DAI loan can be paid back. It's as easy and as simple as that. Right now, you can see the collateral ratio is 168%, which means there's 168% the amount of collateral as there is the amount of DAI. So for every one DAI, there is $1.68 of collateral collateralized. Hopefully that makes sense. Collateral ratio and LTV are two sides of the same coin. I usually think in terms of LTV, but collateral ratios are sufficient. It's good to be able to switch back and forth between the two modalities of thought. Okay, so the two important things here we have is DAI collateralization and then DAI generated by collateral. And I'll explain the differences. DAI collateralization just means what DAI is collateralized by, or effectively what collateral has been added on MakerDAO. You can see the vast majority of it actually isn't USDC. The vast majority of it is Ethereum or other types of Ethereum. We have Ethereum A, Ethereum C. These are just effectively Ethereum that you can refocus. Try again. There we go. It's just Ethereum. So we have Ethereum, we have others, we have Bitcoin, and then USDC makes up 22%. So Ethereum is still the largest amount of collateral for DAI. However, DAI generated by collateral is mostly done by USDC. Now, why is that? That's because you can mint a lot more DAI against USDC than you can against Ethereum because of the LTVs, right? Ethereum is an unstable asset. You want a big buffer between your collateral value and the potential liquidation value. Like Ethereum just went down, 33% in the past few weeks? So if you had a loan out and you borrowed a lot against your Ethereum, you would have gotten liquidated. So people would generally borrow at a 200% collateral ratio, which effectively just means that the Ethereum that they deposit is worth twice as much as their borrow. Now with USDC, people borrow 95% or 98% or at a collateral ratio of 110%, which is really, really low, which just means that their USDC is only 10% more than the DAI they borrowed. Right, so you can borrow way more against USDC, which is why DAI is mostly generated by USDC, or at least USDC is the primary generator of DAI as collateral. So that's it, right? So the cool thing here is that unlike USDC and unlike USDT, there is actually more collateral, 68% more collateral than there is DAI. So it is very, very much backed, and it's decentralized. And we can look at all the on-chain analytics to see this. This comes from the blockchain. This isn't just a made-up report by some website. So, and you can look at the Dune analytics as well. I just think this is a better visualization. So that's the benefit of DAI, right? However, people say because USDC can be frozen or seized, USDT can also be frozen or seized, though the USDC reserves could be frozen or seized in DAI. While that is feasible, there is a world in which that could happen. USDC is fully exposed to USDC. DAI is only partially exposed to USDC, and technically there's enough collateral to lose the USDC to some extent, to actually a very large extent, and get more collateral from Ethereum and Wrapped Bitcoin. So, so I like DAI. I'll be honest in my bias because it is decentralized, and its only real the only real thing against it is that a large portion of its reserves are USDC, 22%, which honestly isn't that bothersome to me. Okay, so we've talked about collateralized, we've talked about over collateralized. MIM is another over collateralized, but I do want to point out something that that gives me a slight pause. I like MIM. I think that most over-collateralized stablecoins are fine. From Chi Finance, DAI from MakerDAO. There's also Rise, another good one. Anything that's over-collateralized, I generally like, right? MIM is over-collateralized. You can go to borrow, you can see all of these types of collateral and all of these, looping possibilities, which is really cool to leverage up your APRs and APYs. Of course, play with leverage responsibly. And in the event of depegging, like, please be aware of the risks. But the one thing I don't like is that in the tools, you used to be able to look at analytics. Now it says work in progress. Well, there's a little secret to see the former analytics by clicking open a new tab. And they haven't updated their analytics since March. And in March, the majority or the largest collateral was in UST. So I don't know what this looks like now. I'm sort of upset that this isn't updated because it's a really, really cool dashboard, and it's really, really helpful and informative. This is exactly what I want to see when I'm looking at the collateral for an over-collateralized stablecoin. So unfortunately, this has not been updated since March, so I cannot say what it's collateralized by now. I guess there's a reality in which we could go down through every single blockchain available, which is all of these, and add up all of the MIM borrowed, and then try to look at all of the collateral and see. I'm not going to do that. So all I'm saying is that I haven't found a reputable analytics page for MIM yet. However, the mechanism should be such that it is far over collateralized, right? Just by virtue of its mechanism. But I just want to put that out there because this is the best we have, and this is out of date. So do keep that in mind, right? In terms of over-collateralized stablecoins, MIM, therefore, for me, is sort of like lower on the list. And I love over-collateralized stablecoins, but that's just the reality of the situation right now. If there is an analytics page out there, please, by all means, go ahead and show it to me. Now we're going to talk about partially collateralized stables, like Frax. So Frax has an 88% collateral ratio, which means 88% of each Frax dollar is backed by assets, which is a lot, but that means there's 12% exposure to FXS, right? 12% exposure to FXS's algorithmic, fill in the gap, right? So UST was completely algo backed. Whenever UST went below $1, what would happen is Luna would be minted, and then that Luna would purchase UST, and that UST would be burnt. So not only was there buy pressure on UST, but additionally the UST would then be burnt out of circulation. So you're reducing supply and increasing buy pressure. That's how the peg was maintained. There was no collateral backing. People say that the Bitcoin was soft collateral. Well, how did that work out? So here, 12% of Frax is exposed to a mechanism like Luna. A seigniorage model is what we call that. So do keep that in mind. I would say as a result that you have a 12% depegging risk. Right now, Frax, very robust protocol, but UST was literally, I believe at one point, the second largest stablecoin in the world. So to say that Frax has more stability than UST, or more likelihood of stability than UST is something that I wouldn't necessarily say at this point. But I like Frax. Frax is definitely my favorite partially backed algo, or partially backed stablecoin, but it is exposed to 12% algo, right? 12% algo backing. Now they're talking about making it backed by Frax. So making it backed by FXS. They're talking about making that last 12% actually backed by, instead of algo based. So that's something to be aware of, right? Now there are a few of these. Day is an example of one that started off much like Frax or a Frax fork, but is now actually both Frax forkish, so partially backed, as well as over collateralized. Now you can mint it against collateral. So I think that was a really healthy move, really smart move by Day, and I will say I tip my hat to them, and I do hope that they continue to be successful. I really hope that they're successful with their derivatives markets and their synthetics, because that could be really big for the Phantom blockchain and the other blockchains that they operate on, especially now that Terra's gone down and they're synthetics and forex is out the window. Okay, cool. So we've talked about collateral. We've talked about over-collateralized. Now we've talked about partially collateralized. We can now talk about the algo-backed stables like USDN. Right? USDN and UST and Bean. I mean, I think just that list of stables probably sells enough because all three of those stables have gone off peg. Now, granted, Bean fell victim to an exploit. UST was a bank run. UST was a bank run death spiral, which is exactly what people predicted as early as 2020. Now, I was not privy to this information. Had I been privy to it, I don't know if I would have taken it seriously. It's difficult to say how blind you are to things that are right in front of you. But UST, well, let's look at UST. UST, as I said, was algorithmically determined. It's at 15 cents now. It may go to 33 cents if they pass that proposal. But effectively, again, UST goes above peg. If UST goes above peg, which is great, then Luna is burned. UST purchases Luna, puts sell pressure on UST to bring the price down, and then that Luna is burned, decreasing the supply of Luna, which is why when Anchor was really popular, there was so much bullish activity in Luna, because Luna was being burned at incredibly high amounts. When UST goes below peg, the opposite is true, which is why Luna became hyperinflationary, and anyone who understood the tokenomics was able to short Luna, knowing that supply was going to increase way faster than demand, especially with all the FUD around the ecosystem. I personally made a small profit off of shorting Luna. I have friends who made over 100,000% profit, and hats off to them. I also have friends who lost their life savings due to UST. So it is a tragic scenario, and I now have to agree with Oxams, but also with Vitalik, that I will not be investing in algo stables, as tempting as some of them are. Right now we have USDD, right? Everyone was super excited about USDD last week. USDD was effectively a UST fork, clone, whatever you want to call it, another algo stable, and it offers 40%. Right now, 40% liquidity pool mining rewards with USDT on Sun. So if you want to expose yourself to, algo stables, there you go. There's your opportunity. I will not be doing it. One thing to note here is that USN is another asset we should be talking about. And the reason we need to talk about this is because I don't want USN to get caught up in the UST FUD, because it wouldn't be fair. The reason why USN was compared to UST initially was, I think, because Near was trying to benefit from UST's success, right? USN, clearly similar to UST. It's US, then one letter. They were also going to offer a 20% APR, very, very clearly copying Anchor, right? So USN, UST, 20%, 20%. There were a lot of parallels to be made. However, USN is not an algo stable. It is soft pegged to the US dollar. Okay, that's cool. But it's backed by a reserve fund that contains Near. It's actually double backed along with USDT. So if you're fine with exposure to USDT, keep that in mind. If you're not, keep that in mind. The core stability mechanisms consist of on-chain arbitrage and of a self-balancing reserve fund based on the currency board principle. Combining the growth potential of and the strong peg defense of Frax, USN is positioned to be one of the most effective. Cool. What I want to get to is the double backing. Here it is. Okay, so the Near used to mint USN goes to the reserve fund. Now we've seen this methodology before with like DAI and MIM, where when you mint USN against something, then that thing becomes the collateral backing. So here we have that. Near is used to mint USN, and that Near goes to the reserve fund. The reserve fund is used to back Near. However, Near is also backed by USDT. So it is double backed. we see here that USN will initially be double collateralized by NEAR and USDT, the latter of which is pooled on NEAR's main DEX, Ref Finance. So if you're unfamiliar, Ref Finance is the main decentralized exchange and farming opportunity on the NEAR chain. You can look at that on DeFi Llama. And other centralized exchanges to secure USN's peg to $1 on the open market. Okay, cool. Worst case scenario, the decentralized bank could buy back the entire amount of USN because it is fully backed, right? Now, here is the important thing. That is only true as of right now for the first 1 billion USN. It is unclear whether USN will continue to be double backed, partial backed, or none backed, or any combination of backing, any percentage of backing after the initial $1 billion mint. So that is one thing to keep in mind, one thing to follow, one thing to watch as you consider stablecoins out in the wild. Okay, so that's effectively it. There are many kinds of stablecoins. We should no longer consider algo stables. We can call them algo dollars, something like that. But they're not stable. Again, Bean, USDN, Basis, which Do Kwon actually worked with anonymously, and UST, right? They're all vulnerable to things like bank runs. Okay, so hopefully you guys learned something from this. I am incredibly sorry if any of you fell victim to UST. I, lost some money there. My mom lost quite a bit of money. It's a bad day. So hopefully you guys gained some information from this. If you have any questions, leave them in the comments. Reach out in the Discord. I'm pretty active in both the free and paid portions of the Discord. We just have more resources and like mods in the paid portion. But if you have questions, feel free to ask them. Thank you guys so much for watching. Have a wonderful rest of your day. One more thing. Because I try to do a lot of research or cover a large breadth of a topic, if I got anything wrong, like super, super wrong, please let me know in the comments. What I usually do when that happens is I pin that comment immediately. So I'm not going to run away from being wrong. If I've missed something fundamental, please let me know, and that'll be the top comment that everyone sees. Thanks again. Cheers.